Right then, ladies and gentlemen, thank you very much for carving time out of your very busy schedules this afternoon on the 1st of October, right at the start of the final quarter of the year. We don't take your time for granted, so thank you very much for making time for this conversation today. Over the next 70 or 90 minutes, we'll have a fairly interesting conversation. And at the heart of it, we're essentially exploring what exactly opportunities are coming up in the wake of the divestments that we are seeing by some international institutions that are exiting certain markets across Africa. Standard Chartered, BNP Paribas, Société Générale, they've all left specific markets, right, up and down this continent that we all call home. And that in turn is opening up opportunities for local champions from West Africa, from East Africa, from Southern Africa. And also, we're seeing some fairly interesting investments coming through from North Africa into East Africa. It's opening up opportunities for all of these institutions to then fill in that gap. But there are questions that this movement leaves in its wake. For example, this subdued international presence that we might eventually end up with, might that in turn constrain forex availability? Might it limit access to overseas investment partners for the large projects that we know we need desperately up and down the continent, like Grand Inga, for example? Might it also prolong a downward trend for correspondent banking relationships? And if that happens, how do we fix that? We'll be exploring that in detail in the course of this webinar. And we've got a fantastic panel lined up for you to help us explore those issues in a bit more detail. But to set the stage for the conversation that is about to start, let me bring in Nicholas Norbrook. He's the editor of the Africa Report. He's got an interesting presentation that will essentially set the stage for the conversation we're going to have over the next 70 minutes. Nicholas, over to you.
Nicholas, your mic is muted.
Apologies, a rookie error there. Before we get going, I just want to say hello. Hope you're all doing well, feeling safe. A lot of bad news out there at the moment. So concentrating on bank balance sheets might not be always so easy. But the accumulation, the deepening of these domestic capital pools on the continent is literally the base of all our future growth here on the continent. So we can't have a prosperous Africa without it. Banks to insurance to African institutional investors, we need it all. We know it's important at the Jeune Afrique Media Group. We know you do too, because you've tuned into this webinar, and thank you for it. And we need you, our listeners and viewers, more than ever, because it's you, our extremely well-informed and articulate audience, who've been helping us to improve this ranking that we've been doing now for almost 20 years. The ranking of Africa's leading banks, and we've been publishing in our two publications of Jeune Afrique and the Africa Report. But starting last year, and with this as the second edition, we've actually changed the way we do it, based on conversations with you, the experts in the field, and with our partner organizations. So rather than looking at just assets, we now assess Africa's leading banking conglomerates, ones with a holding company and subsidiaries in at least one African country beyond their HQ. And we rank them on 5 criteria: profitability, liquidity, solvency, asset quality, and size. And each criterion has a subset of various indicators. We've got about 20 that are used. You can engage with all that on your own time at the Africa Report and Jeune Afrique, and we really appreciate it. You get in contact over LinkedIn or any of our channels. So what is the big picture? After Société Générale's exit, the 5 largest banking networks in Africa today are African groups. EcoBank with 33 branches in Africa, UBA with 20 branches in Africa, Standard Bank 18, BMCBOA with 16, and Attijari Wafa Bank with 15. Now, the largest groups and networks are not always the most profitable or effective. We see Nigerian banks at the top, South African banks in the middle, Moroccan banks currently at the bottom. And it raises questions about the effectiveness of these models, but also highlights the difficulty of being highly profitable while at the same time trying to be a universal bank financing the real economy. And overall, in our sample of 28 institutions whose performance is rated on these 14 data points covering profitability, liquidity, solvency, credit quality and risk, we find that the financial solidity of these banks is generally good. All have a capital adequacy ratio, measures the ability to withstand financial stress, higher than 8%, which is the minimum required under Basel III regulations. But while they may all have different levels of profitability, and it'd be great if we could have the fourth slide, one thing that is clear is that the resilience in the face of successive external crises, we can all name them, COVID-19, Ukraine, inflation spikes, debt crises, this ability to stay the course is seen through the capacity of African banking groups to actually generate profits. The average return on equity has been around 19%, and that's not a bad figure, especially given the circumstances. Let's have the next slide. Nonetheless, we have high levels of political instability and security challenges. We have a high number of African states needing financing and asking the banks to finance their budget as a cost. When more lucrative and safe government bonds are available, banks often struggle to also finance the real economy. Who can blame them? You know, you've got risk-free assets on offer. That's what you go for. That's possibly the case in a country like Nigeria. But when you do try and finance the real economy in countries like Kenya, Morocco, South Africa, they seem to be more able to do so. But it's often to the detriment of their credit portfolios. We have the sixth slide. And you can clearly see the different business models, perhaps, and the different levels of risk-taking relative to the total balance sheet. Most of the banks at the top of our ranking follow a model where their loan portfolio is less than half of their total assets. First round, perhaps an exception here, as it manages to both lend a lot and is just outside the top 10. The problem comes when they're cautious and conservative, like with the Nigerian banks, as we were hearing. They do make money, of course, but it's at the expense of financing the real economy, infrastructure, SMEs. And we can also see that all these major groups are in a consolidation phase. They're not actually trying to improve their performance. They're not interested in, for example, purchasing Société Générale subsidiaries. Those who are interested are the smaller growing groups like Coris Bank, and I'm sure we'll hear more about them later. So the question I would like to leave you with is the following. How can banks successfully finance the real economy while still making money? Thanks for listening. Again, please do reach out on LinkedIn or answers on a postcard. Back to you, Rama.
Well, hopefully that postcard will be sent in from Casablanca. More on that later on at the end of the session. That said, thank you very much for setting the stage, Nicolas, because there's always that interesting balance point, right, that a lot of banks will have to face. There's opportunity out there, yes, but what's the risk perception that we're actually going into? What's the gap between actual risk versus perceived risk? And, lending into the real economy at a time when, sovereigns up and down the continent are essentially willing to just borrow money at, double-digit rates, 16% here in Kenya, north of 20% in some markets in West Africa. So there's a lot more to dig into that a little later on. But right now, before we get into the panel discussion, I'd like to bring in Aurélie, who's part of the Jeune Afrique group, who has a special interview lined up for us. Aurélie, over to you.
Thank you, Rama, and hello, everyone. Nous allons poursuivre cet événement digital en français.
And we're going to carry on in French because we have Mr. Mohamed Ba, the CEO of the Jeune Group from 2023. He's the leader of the insurance bodies in Western Africa, and it's a Pan-African group of financial services present in 17 countries of Africa, dealing with banking sector and insurance companies and microfinancing institutions. Mohamed, hello and welcome. Hello, Aurélie, says Mohamed to Aurélie, because I think Aurélie says to Mohamed that you are one of the main artisans of the expansion of the certification of the SUNU group, which is your analysis regarding the notation of the 300 African champion. And if we can reply to your question of my colleague, how can we better finance the African economy? Thank you very much, says Mohamed. It's a very, very interesting question, effectively. And the notation, the ranking is brilliant because we can see how we are in terms of rank, and we have a good rank, and we can see that the Nigerian bank behaved very well. And I think the size, the market sizing is important. And at the same time, we can see that our Pan-African banks are very efficient in terms of operations, cost efficient with 50% of productivity. So that's quite interesting. And we can see that they're very lucrative. And in order to reply to the question of Rama, in order to be more lucrative, profitable, we need to increase the assets. And we've got brilliant opportunities in front of us because we can see at the same time that the rate of penetrations are very low. And today, we've got the availability to have access to new clients thanks to the digital area scene. And I think the future is like that. We're going to be able to better finance private people and the SMEs. But what is at stake? And I can see at the moment when I see the ranking, it's the capitals, because Africa needs to face questions regarding the capitals. And in order to be present, we need to have access to more of our own funding, and we need to increase the capacity at the banking sector to invest better to the companies. That's what is at stake at the moment. And I think and I believe in order to have access to multinational banks, in order to finance our development, for them to support us, and at the same time to call to public financing, because there are a lot of Africans who are capable of financing in Africa and funding themselves. So we are the first group of insurance at the CIMA zone, but at the same time, we need to be able to use that funding in order to capitalize better. Thank you very much, because you've been evoking the various opportunities, and we are within, that's the theme of this session at the moment. We can see how we can see the current context at the moment on the map, and you too within the SUNU group, you were registered within this type of dynamic because recently you took Paribas Senegal as a subsidiary to control over it, and now it's part of the SUNU group. Maybe there are quite a few other operations that your group is looking for in order to do more economic expansion. But according to you, Mr. Mohamed, what is the ideal model for an African bank to have several subsidiaries, to expand, to look beyond, to see how the foreign establishments are leaving Africa? I believe, says Mohamed, that we need to have a clear strategy in terms of expansion, and that's what we have within the group. We have the ambition to do within 25 years, like we did it for the insurance world. We've got clear strategic ambitions at the moment. Besides that, we need to be open to the various opportunities that we need to seize, and that's the reason why we need to keep doing that. And I remain convinced that we are talking a lot about sovereignty of our nations, but I believe that sovereignty means mastering your financing. And I believe that our nations have understood that, because the last transactions that were made during the foreign group that left us, the various nations played their roles because they said we want for African stakeholders to be present and to fully master cluster financing, but in order not to be beyond the excess, because the state needs to be the arbiter, but at the same time, it is in our interest to support the various protagonists, various regional protagonists, to help them within the structuring and the regulations, except and not seeing them simply as competitors, because that's what it is, you say, Zorelli. We need to see the role of the state, the role of the nation to be an authority, to have a kind of support, more than dictating what needs to be done, and to see who's going to retake. Yes, of course, says Mohamed, we are waiting for the various nations to consolidate into regions relationship, because I believe that today, if you can see it, for our commercial situation at the moment, we need to develop regional added value change, and we need to be less dependent from foreign companies, because what is at stake today and what are the banks that we have bought back? It's the access to banking investment. The European Bank wanted to be the mediator, but today there is a kind of conformity regulation side in this respect, and there's we need to take the risk as well. We need to develop the sector of the SMEs and SMIs, and we need that the expectations we can have as a protagonist is to invest fully according to the regulation and to master better the risk, because, for example, we've got cyber risk, cyber criminality. We need to master that. Another thing at the same time, I think the various nations, the various states, they need to support the various actors, protagonists, regionally speaking. We talk about SECA a lot the last few months. On all these structures, financial structures, banking structures, that need to take part within the regional market. Today, if we need to be satisfied to stay within the nation in which we are, we're not going to be able to develop. We believe within the SUNU group for the regional aspect, but at the same time, we need to expand, because all the various nations need to be working to support us in this respect. We fully understood, says Aurélie, for that. Thank you very much, Mohamed Bad, for this interview and for your point of view on the various themes. Rama, up to you. Thank you very much. Thank you.
Merci beaucoup, Aurélie. And of course, we're going to be having a lot more of these conversations later on in Casablanca in the second week of December. Now, however, let's get into the meat of the discussion with the panelists that we have, who've so generously carved time out of their schedules for us this afternoon. I'd like to introduce him as a show up on your screens at the moment. We've got Akinto Daoudou, who's a cluster head for Sub-Saharan Africa over at Citi. Rida Mefta is a partner at Ernst & Young. We've got Anastasia Kimtai, who's a managing director for KCB Bank, Kenya Commercial Bank, the Kenyan operations of that conglomerate over in Eastern Africa. And of course, we've got Gonzague Montreal, who's the head of financial institutions at Proparco. Over the next 40-50 minutes, we're going to be delving into three parts of this conversation. To begin with, the new gateways, right, for intra-African and external trade. Now that we're seeing a lot of these international franchises starting to sort of pull out a bit in some markets. The questions around guarantees and liquidity and overseas expansion. What are the essentials, right, that local banks within Africa, the standard banks, the KCBs, the UBAs, the FNBs, what do they need to essentially be able to expand, not just within their regional markets, but beyond that as well? And finally, and most important, how do we preserve access to foreign currency? How do we invest, or how do we rather build up international investor appetite and preserve correspondent banking relationships? All that and more will be essentially our guide for the conversation that we'll have at the moment. Just a couple of reminders for those of you who are joining us on the webinar. If you've got questions, there's a Q&A box right at the bottom of your screen. You can certainly leave questions for the panelists right there for us. Also, if you essentially would like to have this conversation heard in a completely different language, if you go down to the bottom end rather the options at the bottom of your Zoom webinar, you'll be able to actually see an option there for translation into a completely different language. You'll be able to hear the audio either in English or in French as you prefer. I want to get into the meat of the conversation at the moment. And I'm going to start with you, Anastasia, because, you know, we're speaking here about expanding, right, to fill in the opportunities that we see in different markets. And in some instances, that's been a really challenging thing for some franchises across Africa. You know, UBA, for example, spent a fair bit of time expanding across the African continent over the last decade and a half. It finally did pay off, but the initial stages of it were a bit controversial. So from your perspective at KCB, I know your immediate focus has been consolidating DRC, and Ethiopia is a market that everyone's very keen to get into. But beyond that, what are the other growth opportunities you're seeing?
Thank you so much, Rama, and it's great to be with you this afternoon as we deliberate and look at opportunities where we can consolidate as the financial industry within Africa to take advantage of the trade opportunities which are available in Africa. Allow me to start by saying the banking sector stands at a very critical juncture. And as the continent economies grow and the regional trades accelerate, there is every reason for us to make sure that we are aware and alive to ability to support our customers. And more specifically in your introductory remarks, yes, we've seen some of the global banks leave the continent. How then do we become prepared as African banks to take advantage of this opportunity and work with our customers? And allow me to start by saying, we do have in Africa a finance gap of 81 billion annually. And that gives us a great opportunity. But having said that, then we must change the way we are working to be able to meet and take advantage of this opportunity. And one way that we can be able to meet and do this is through digital transformation and innovation. Embracing digital banking solution is essential because with this solution, you are actually able to penetrate the market within Africa. Africa banks must invest in technologies that enable efficient, fast, and secure cross-border transactions. We must leverage technology and the fintech partnerships so that there is enhanced transparency and reduced complexity of trade finance. Digital lending platform, data-driven credit assessment, and mobile banking can actually broaden our ability to play in this sphere. In the area of trade finance services, in the year 2019, brought by the global health crisis, this has extended our ability to be able to meet the customer requirement through leveraging technologies such as machine learning, artificial intelligence, and optimal character recognition. But the challenge is African banks, where are we in terms of leveraging these opportunities so that we can be able to take care of this advantage? The second area that we've also seen that will propel the banks is strengthening both the local and the regional partnership. It's high time that collaboration is critical to building our resilience as African banks. Africa banks need to form alliance with the regional financial institution, multilateral development bank, so that we can be able, using the capital base that we do have, to meet the needs of our customers. We are aware that majority of us do have correspondent banking across globally. We've partnered with the like of AFRIEXIM, the like of Africa Development Bank. We need to really reflect and ask ourselves, how then do we strengthen our capital position so that we can be able to have our own in-house solution to meet this trade opportunity?
Let me just jump in.
Point of reflection.
Let me just jump in there briefly, because you raise an important point, and I'd like to essentially expand that question and put it to the wider panel as well, because one of the big narratives that I remember we had last year was this talk about de-dollarization, right? If I'm a rice farmer, for the sake of argument, here in Kenya, and I want to export my rice into the Nigerian market, huge market for that particular commodity, I am willing to bet that many farmers here would not be willing to take payment in Naira, right? And vice versa. You know, if you're a Nigerian importer, why would you essentially accept payment in Kenyan shillings? But I want to put this question to the wider panel. You know, de-dollarization, or essentially moving to a lot of more of our trade to currencies within Africa. There's been a lot of talk about it. There's been some work done, to make sure that that happens through PAPS, for example, which is an Afrexim Bank product. But have we gone far enough, and what more needs to be done? Dawoodi, I want to start with you, and then we can bring in Rita and then Anastasia.
Would that be me, Rama?
Oh, yes, absolutely.
Oh, yeah. You used my surname, so I was a bit thrown for a second. Okay. Look, it's a valid point. I mean, one of the key issues here is that Africa does not trade with itself, right? If you look at the statistics, depending on import or export, or you're taking an average, only about 15% of Africa trade is intra-Africa. So I think a key issue there is creating the demand, and for our own currencies amongst ourselves. And for that to happen, you have to have the throughput, you have to have the activity, you have to have the interaction. And of course, the obvious thing to talk about here is the AFCFTA, which has been signed and has been launched, but is obviously slow to gain traction, as these things often are. There needs to be a great push to really move that along. PAPS is a good start, but I think the engagement of all the central banks in the continent and their support for the initiative is critical for it to succeed. The technology, the platforms, the rails on which this intra-Africa trade will actually run or operate need to be built over and above some of the rhetoric seen so far. And all the barriers to intra-Africa trade we need to be more systematic and focused about removing them. Non-tariff barriers, the logistics, intra-continental travel, customs, borders. I mean, one of the most worthy initiatives I think I've heard about in recent times is the SGR railway across East Africa. That kind of infrastructure, that kind of capacity, those kind of rails, literally and figuratively, are what the intra-African economy needs to run on. We need to make it easier to move around. We need to make it easier to move goods around. We need to remove the friction and to enable the trade and that activity. And that will create the demand for the currencies, for each other's currencies, that will then allow us to de-dollarize, quote unquote, to some extent anyway.
So within the context, is it that we're sort of approaching this in reverse? Should we do it? Are we doing this in reverse by trying to set up PAPS, yet at the fundamental basis we're barely trading with each other, we barely travel within the continent, therefore the impact that something like PAPS might have might actually be somewhat limited?
Well, yes, but you have to start somewhere, right? And maybe if you wait for the enabling environment to be 100% perfect, maybe that still takes a while. So PAPS is a good initiative in principle. I think the challenge with all these things is always, how do you actually make it happen? How do you get the right people aligned? Who can give it teeth? Who can make it work? Before we do the rollout and the publicity, have we actually built the actual rails? So yeah, which came first, the chicken or the egg? We can debate that, but I think it's a worthy initiative, and the key is to get it to work. If you build it, I think they will come, but we have to build it properly. And I think that's the process that we're trying to do now, and we've got a long way to go.
Indeed. And, to your point, Leia Abede in the chat is actually saying, at CFTA FinTech Solutions, they say they've built a multi-currency solution for African currencies, but he says they're still waiting for uptake and collaboration from regional banks. Rita, I want to come to you on that exact same question. Do you have a different perspective on this question around de-dollarization and actually moving to a lot more trade in the Rand, the Naira, the Cedi, and so on?
Thank you, Rama. I'm very happy to be part of this webinar. But let me perhaps share some numbers to have the big picture that can help us to identify some gateways or some interesting solution. already said, I think that, today intra-African trade is around 15%, compared to 60% in more integrated regions. So we are not trading within Africa. The second number, which is important, is that there is a structural trade deficit around 50 to 60 billion, mainly driven by imports of goods and electronic equipment. The third number, which is important, is that foreign exchange reserve related to the issue of the dollarization is around 4 to 5 months of imports for all Africa. So there is no lot of reserve in foreign currency. And this with a great fluctuation of US dollar and impact mainly volatility of foods. The fourth is that Africa trade currently with Asia, with the focus with China and India, as you know, and recently with Middle East, compared to heavy reliance on Europe and North America. So we are around 50% of our trade outside Africa is with Asia, and currently we see the move from to Middle East also, which is involved mainly in trade of some raw materials in Africa. The last number, which is important, and I think already raised by Mohamed, is that the financial sector today represents 1% of total asset or share of Africa asset compared to the global financial asset for a continent that represents tomorrow 25% of global population. I think that these figures are interesting to say that the first point is that we have to trade with local currency. And I think that there is no choice for African countries rather than to trade in local currency. And for that, I think that there is a lot of, let's say, solution. I think PAPS, sure, is an interesting solution. But digital African currency for intra-African trade can be an interesting platform solution with some region that can be backed with African commodities like gold or oil on the agricultural product. And I think that we can think around Pan-African, let's say, platform for settlement and payment that involve much more countries, much more Pan-African player in this platform. And it's not a question of technology, of capacity. I think that is a question of to go forward and to make it happen. The second point, which is important for me, is that when we talk about one person, the size of financial institution, is that clearly we need a partnership. But I think that the idea is that it's the time to choose which kind of partnership and which kind of smart relationship we have to implement between international partner and rising local partner, because the idea is that when we talk about the implementation of regional supply chain, they need infrastructure, they need a huge amount of investment, they need a huge amount of equity, and taking the size, the critical size of our player, we have not sufficient resource for that. So I think that the second point is that how to involve differently international player to have win-win partnership to invest in Africa without losing this autonomy on local currency. I think this is the top point, but we can deep dive it further if you want, Rama.
Indeed. And I want to get to an interesting question that's been posed here in the chat, I think to all of us really on the panel. This is from Valerie Nem, the founder of Invicte. And she's asking, if Africa is the new frontier, why are all these foreign banks leaving? right? If Africa is a new frontier, we say there's opportunity in the DRC, country of 100 million people, largely embanked. If, you've got Ethiopia, a market that's been largely closed off for many, many decades, that's now starting to think about letting foreign capital and foreign banks in. You've got, if these are the markets that have so much potential, why are people living? And I guess, I can put that question to you, Gonzague, before I go to Anastasia.
Thank you, Rama. Excuse me. And I think there's a very easy explanation to that. It's essentially for regulatory reasons. It's become so expensive for Western banks, if you like, to allocate capital to markets such as the African markets, that they've decided to concentrate on markets that are less expensive from that perspective. It's also the considerable regulatory cost in terms of compliance. The different levels of compliance regulation in Europe and in other countries have become so stringent that it's become difficult to meet those standards in many of the markets where these banks used to operate. So these foreign banks in many cases are leaving the continent reluctantly because they did see potential from a commercial and financial perspective there, but it's become difficult to match with the regulatory constraints they have to meet in their markets of origin, I think.
Anastasia, same question to you, and I guess I could also put that to Akinso on at some point, because Citi's been around for a while, so it'd be interesting to hear your perspective on what the opportunity is like in real terms across African markets. But Anastasia, I wanted to weigh in on this. If there's so much opportunity, why all these companies leaving? I mean, Gonzague has given us one perspective with respect to regulatory requirements and capital requirements in their home markets, but are there other reasons why they're looking at African markets and saying, well, we're probably just better off outside?
Thank you so much. Let me start with the last question. If there's opportunity in Africa, why are these international banks leaving? And it's a fact that there is opportunity in Africa. By the year 2030, a quarter of the world population will be in Africa. The reason why we see a lot of industries, banks leaving is one, our ability to mitigate risk. And why do I say this ability to manage risk? Because of stringent regulation requirement. Right now, can you follow a transaction and track it end to end? That we are still way, way behind. And that's why whenever we talk about the opportunities to enhance our risk management framework, you will realize that we don't have adequate risk assessment in most of our businesses. So because of that and the high penalties, then you will be forced to leave Africa. Having said that, if you look at our trading platform, and over the years, we all know as financial institutions that we've been leveraging on SWIFT. Have we really established and expanded our trading platform for the ability to pay and settle? No, we are not where we are. And that's why we all need to come to the table to inform policies and processes so that we can have this platform, that we can be able to have an open and transparent trade environment where we've mitigated the risk. Another thing that I'd like to talk about is the ability of partnership. And allow me to talk about the government-to-government partnership that we did last year under the importation of oil and has worked so well. As African banks, we need to be open to new ways of doing businesses. When we went into G2G partnership with Far East, most of the African banks were actually concerned and worried. But what has this done to us? It ensured that we did manage our exposure to FX risk. And we were able to make sure that the 4.1 months coverage of our import was actually used to finance the import as we structure and plan how we will pay for oil and gas in the economy. And that has worked so well. So as an African bank, we need to be open to new instruments of trade that can enable the banks that don't have adequate reserve in terms of foreign currency plan their usage, and meet the other requirements. Finally, we must strengthen our capital base as African banks. And for big, huge projects, we've always partnered with international banks because we don't have the adequate capital base to undertake this huge project. So for us to thrive and really make impact in regional trade, then we must strengthen our capital base so that we can be able to offer this solution and actually bank our clientele. We also need to leverage on partnership. It's a fact that we are coming from a position that we need to strengthen our institution. So the only way to move forward is to ensure that we have leverage on existing partnership as we maximize on the future. And finally, is to make sure that we have skills and competence to structure some of these very complicated trade solutions so that we can play in a platform or an environment where we are able to meet the respective customers' need. So allow me just pen it off by saying those 5 critical aspects, if we are able to address as a region, then we can be able to play effectively in the regional financial services. Thank you.
I want to take you into a tangent that you've raised in your response, and Rita also raised it in his response. You know, a lot of our trade, if we were having this conversation, say for the sake of argument, in 2004, right? If you looked at our share of imports, a big chunk of them will be coming in from likely Western markets. Fast forward to 2024, most of our imports are coming in either from within African markets or they're coming in from the Middle East or from China. And given that, because you're seeing a lot more capital flows coming into, or rather being established with markets like China, where the RMB is essentially still predominant, is that a place where banks need to start looking at in terms of raising capital potentially? Because as far as I know, and I could be wrong, only ICBC has invested in Standard Bank, but beyond that, we've not really seen a lot of Chinese capital making a serious effort to come into the African market. Is that a market that potentially African banks need to be looking at in order to plug the capital gap rather that you've mentioned, Anastasia?
Thanks, Rama. And absolutely, you are spot on. If you look at the kind of trade that currently Africa is undertaking with the Far East, allow me to say India, China, and all those other countries in the Far East, what they've done is they've facilitated the business people to come and invest and undertake this solution in Africa. They have not gone ahead and released these funds for the African bank to invest. And if they have, it's a very, very small amount that they put there. So there's a very big opportunity in terms of the working model of how can we facilitate this partnership. And I'll keep on giving the example of G2G. Can we replicate more of government to government with the Far East, with the Chinese banks, so that we can leverage on this, rather than a situation which has worked so well. And if you look at Africa, Rama, as at now, you will actually see a lot of partnership with the Chinese in terms of infrastructure development. How can we turn this around and make sure that we have a partnership of strengthening the capital base, that the African banks are the ones who are undertaking this, and there is a reason for the Chinese to go into this model in terms of the return to their investment at the end of the day. And that's why we're challenging ourselves and say, let's not look at the traditional instruments where we are partnered and leverage on this relationship. There are new opportunities that we need to take advantage on and strengthen our relationship so that we can now have strong partnership, the way we've done with the Africa Development Bank, the way we've done with IFC. Start doing this with the Chinese banks. So you are spot on. The model is totally different. We must get a new model that works for us as the African banks. Thank you.
Rita, I want to go to you on that same question before I get into my next one.
Yeah, thank you, Rama. I think that just a quick element on the first question regarding why they exit international banks from Africa. I think that in addition to the point related to regulation and the cost of capital, I think there is 2 reasons. The first reason is that these international financial institutions need money, need capital to invest in technology, because they are historic player. They have a lot of legacy and all the technology, and they need money to invest in new technology. And currently financial services is moving, and they need to be able to invest in artificial intelligence, in new technology, and so on, and they need capital for that. The second, I think that the paradigm isn't changed. It means that international players see that they can serve Africa without being there physically with an affiliate or with branches. They can serve Africa by facilitating or participating in trade finance transaction or opportunities or guarantees and so on, and taking commission and taking benefit from that without being there. So the opportunity is here, and all Pan-African banks today looking for correspondent, and they looking for historic correspondent, and currently this historic correspondent says no, we are not open, and so they can be open tomorrow when things change. When coming to your question, I think that when I talked about the trade, let's say numbers today, it's clear there is a moving from European, North Africa to the presence of Middle East and China or Asia, and I think that today there is, in addition to the partnership between ICBC and Standard Bank, we are looking a lot of dynamics, at least today, of investor of regional banks in Middle East, for example. We know at least a lot of international or regional banks that are looking for opportunity to invest and to make partnership with Pan-African player. Also for Asia is also important for Africa, and I think that with China or perhaps with India, there is also some opportunities which is under studies, and appetite is here. Appetite to invest from India, China, Middle East is here, and they will start by finding alternative solution to the exit of international banks to positioning themselves that alternative correspondent banking, and to have access to data, to the market, to understand more the market. And I think the second level is to invest and to be partner. But for me, there is one point which is important, and is that this Pan-African group that arises today, and I think that there is a big need that to switch from a financial institution as a family business to a world-class global financial institution. And this is the key point, I think, before opening the market to other partnership or to other player. And this is important to profit from this opportunity. Let's say to have a big Pan-African player instead of changing other, let's say, partner or other actor. Today was perhaps a French actor, tomorrow will be Asian. I think that the idea is that is the situation to create Pan-African world-class financial institution. And this is the point that our Pan-African leaders today that have a Pan-African group, let's say Ecobank, Atlantic, Coris, and so on, have to move and have to think big to move themselves from a family business to world-class. And this needs a lot of prerequisites. First, governance, transparency, compliance, automation, digital, and all of this are required to think big. Then I think it will be easy with this mindset, with this clear vision, with this partnership to attract player, but also with smart win-win approach and partnership.
Indeed. Akinso, I want to come to you on that question around the perception gap, right, between actual risk versus perceived risk. Citi's been, in various markets across Africa for several decades, and you can look around the continent and say, well, you've got companies like UBA, for example, which have got NPL ratios that are fairly decent, single digit. levels. And the institutes that are working on providing guarantees, for example, like the Africa Guarantee Fund, I think just only 3% or 2% of their guarantees have been triggered ever since that institution was set up. So you can look at certain sets of numbers and say, well, the perceived risk in Africa is not necessarily as high as some may think. But from your perspective, overseeing Citi's operations across the region, what do you think on that debate between perceived versus actual risk?
It's a perennial one, right? I think there is a gap. I think Africa does suffer from a perception gap, a postcode bias, whatever phrase you want to use. There's a perception that it's a difficult place to do business and that the risks are high. But Citi has been in Africa for 50 plus years. And, in our history, we've found it's challenging in different ways, but from a risk perspective, it's not more so than many of the other markets we're in across the world. Our loss norms, both in terms of credit losses or operational losses, have been relatively low and over a fairly long time and a decent sample size. So that tells you that you can manage risk successfully and efficiently in Africa. And I think it belies the perception, which is not to say that Africa is not risky. It is. There have been sovereign defaults in the past few years. There continue to be macro challenges, but it is not nearly as risky as the perception implies. And this perception also seeps into the pricing of Africa assets, whether they're sovereign or private sector assets. And definitely that is something that needs to go away. That gap needs to close. In terms of, you talked about UBA and banks like that. I think they've done a very good job in terms of building up their presence on the continent and becoming regional champions, if you like. And to go to the earlier question about why are global banks leaving, why are international banks leaving Africa? The regulatory reasons are valid, capital and all that. There's a general geographical trend, geopolitical trend as well. Globalization is in a little bit of retreat at the moment. International trade itself was down in the last 5 years or so, partly complicated by COVID and co, but just generally, the trend towards globalization has slowed. And that has shown up on our shores in terms of some international institutions leaving. I think there's also a factor of competition. The local banks have become bigger, regional champions, some of the people we've talked about, and they are better at managing risks, especially in the consumer and retail segments, than perhaps the multinationals are in some cases. And these big regional banks are also moving into the small African countries and competing very well. So you'll find that while the international presence is changing and international banks are moving back, they are generally leaving maybe more the retail consumer segment, and they also leaving the smaller countries to some extent where scale is a challenge. So scale and competition, I think, are playing a role there as well as the other things mentioned. And we can't get away also from the fact that the business environment in many of our countries is not progressing as well as we would like. Foreign direct investments are, for instance, somewhat down in major economies like South Africa and Nigeria and have been that's been the case for the past 5 years, 10 years. So of course, that shows up in the financial sector as well. It's part of that general trend. So there's still a lot of work and improvement to do there. But in the aggregate, I'm not sure that financial investment or financial coverage of Africa has necessarily reduced so much. I think it's that people are more strategic and maybe have consolidated their activities a little bit in the bigger markets and have left some of the other markets to regional and local competitors to manage. The gap remains. There is a financing gap, but I think it's a mixed bag. So international banks leaving is not great. There is a need for international presence in Africa. I think it helps. I think it makes a difference. But at the same time, in many instances, it's really partly a testament to development of local and regional institutions, and also just a reflection of broader global macro trends. It's not necessarily the end of the world. The story continues. I think there will be further interest in Africa down the line if we continue to make the adjustments we need to make.
Indeed, it's certainly the optimistic scenario. But I want to put a question to you that's also come in, in advance of this webinar being held. This one is from a participant from the West African Development Bank, Le Banque Ouest Africaine de Développement, and essentially they're asking that, look, is it not possible? To your point, actually, is it not possible to adapt in terms of anti-money laundering or counter-terror financing regulations, and to strengthen governance in order to help the continent strengthen its banks? Or put another way, it's, are we trying to essentially, are we facing a sort of square peg round hole problem here, because we're trying to adapt systems and procedures developed elsewhere and trying to make them work in markets where they may not necessarily apply because of the level of informality that we have in some cases in the retail and small business segment?
Yeah, I mean, I think that's a good point in terms of our economies are very different. The informal segments are larger than in most countries or in more developed countries. So there has to be some adaptability as to how we capture some of those issues. But the technology and how we approach it can be more bespoke or more customized. But fundamentally, I think the question really is, we do need to adhere to higher standards in terms of compliance, in terms of governance, in terms of regulatory standards, to be more in keeping with the wider global standards. And I think that is a very important factor in the continuation of, in continuing to have access to finance, have access to debt, to correspondent banking relationships or trade lines, because one of the constant issues we do face, especially in smaller markets, is around AML and the robustness of the local KYC AML governance. And I agree that maybe the way in which those models are built in the countries can be more personalized and more customized rather than trying to impose a structure that is developed for another type of economy. But the substance of it has to improve. So even if the form of it is different, the substance is there has to be higher governance and compliance and KYC standards across Africa for access to global capital to expand.
Indeed.
And I think that's a reality. And there is some progress in that area, but there's still much to do.
Absolutely, 100% agree. And the comments and the questions from our audience on the webinar keep coming in quick and fast. Ruben Panya is saying, we need to also give our local banks credit, because in a lot of these markets, international players simply were not able to offer better value proposition, he says, compared to local incumbents, which essentially speaks to the point that you're making a little earlier, Kensuan. Gonzaga, I want to come to you with a question, or rather a comment that essentially has been put in here into our comments by Fatima Sawane. And she's saying, local banks need to improve their liquidity positions if they're going to be able to compete, right, with their former international players. And she's saying that this can be achieved by issuing trade finance guarantees and leveraging partnerships with DFIs. And the example she's giving here is, AFDB and Afrexim Bank. But from your perspective at Proparco, what are the immediate needs, right, that African banks come to you with and say, look, I need capital in order to do X, Y, Z? What's been the main pain points that they need to fix?
Yes, thank you. Well, there's one thing they seldom need. It's short-term local currency liquidity, because that they find in the local markets. They have the ability to raise deposits, and that's something that's usually widely available in most markets. What they have more of a need for is a long-term capital to finance longer-term projects, to balance, to put into their balance sheet in front of their longer-term exposures, and this in many cases is in hard currency, and this is where we step in by providing long-term funding under terms that are competitive in those markets. So that's for the funding side. But as you mentioned, there's also a significant need for access to trade finance lines from abroad. And there's several challenges. And one of them is the fact that in many cases, African banks are based in countries with a rating such that international banks are not willing to extend them correspondent lines to the extent that they need. And in those cases, we step in with trade finance guarantees, where we stand between the issuing and the confirming bank on a trade transaction. And this allows the African bank to find a partner abroad who's willing to deal in trade finance transaction with them. There's another issue we've seen increasingly in some regions on the continent, which is the difficulty to settle foreign exchange transactions due to the regulatory delays that are introduced by foreign exchange regulation in certain countries or certain monetary zones. And there what we see is that the banks have a very strong need to access overdraft lines abroad, and these are limited in the size that the foreign banks are willing to extend. And there we are also designing a guarantee where we give a partial guarantee to a foreign bank for them to extend an overdraft line to an African bank, which needs short-term hard currency to settle their transactions while they wait for regulatory approval to get funds out of the country. So these are several practical needs that we've identified and which we work with our clients to enable them to continue investing on the long term and continue trading on the short term, which are the two main needs that we see.
Is it, now that we're essentially getting into the rate cutting side of the cycle, the Fed has cut rates, finally, it was highly anticipated. They've started their rate cutting cycle. BOE still holding rates pretty much exactly where they are. ECB is pretty much on the same path. We're seeing, a general decline in the cost of credit. Do you think that'll make it a little easier to essentially extend that capital that a lot of these banks desperately need at the moment? Or are there other factors that might, impede the deployment of capital? Even if it's cheaper, there might be questions around the things we've discussed. Governance, the potential of sovereign defaults in some markets. Is access to capital getting easier, or is it still problematic?
It's not the impression I have. I think access to capital is not really limited by cost, but more by availability in certain specific buckets. And I'm not sure the change in interest rates is going to change that much. It's more of a question of the appetite of foreign lenders for these types of specific counterparty risk or country risk, and that's where the limitation is, in my opinion.
There's a question that's come up here from Fouad Nicolas, who's essentially asking you specifically, would European or Middle Eastern affiliates of African banks play the trade platform role because they might have access to a better rating?
That's not exactly we've structured it on our side. We prefer to ensure that African banks are allowed to build direct relationships with the banks in other markets by providing these guarantees I've mentioned, because this creates trading ties that will go on beyond our intervention, meaning that once these lines are established and the trade flows have been active, the African banks will keep these relationships over the long term, even if at some point we're not there anymore to help them with that. So it seems like a more long-term solution than really acting as a platform in between.
Indeed. There's an interesting question here that I want to put to Anastasia and Akinsawan. It's from Susan Starnes. She's the global lead for trade and supply chain strategy over at the International Finance Corporation, IFC, one of the big partners that we work with on the African Financial Industry Summit. And the question is, how will the retrenchment of international banks affect the supply of trade finance in 2025 and in 2026. And Anastasia, I know you mentioned the G2G agreement earlier as an example of how, banks in Kenya can work with institutions in the Middle East to essentially meet the needs, meet the liquidity needs rather of importers in the African continent, while also managing the FX risk. But to Susan's question here, with the pullback of international banks, do you see that as a problem in terms of how it might affect the supply of trade finance next year and 2026?
Thank you so much, Rama, for that question. It will to an extent, and specifically because by the time they are pulling out, we have not strengthened the regional banks to be able to fill that space adequately. And then at the time they are also pulling back, you will witness that the foreign direct inflows are reduced immediately after COVID. But having said that, there is an opportunity right now for the banks to pull together and have the adequate base, capital base, to be able to fill in this opportunity. What we mean is that with every happening of an event, then there is an opportunity. And the most specifically one is, how do we have documented, and followed through transaction processing so that the perceived risk level for the African banks is actually done away with. And allow me say that the African banks have come through really so well, and they've actually met a financial need for the SMEs. And allow me reflect on this. The opportunities available right now in Africa are SME. The corporates have actually stagnated. Who are the people who are better informed to meet the requirement of the SMEs? It's the local banks who know the specific requirement and the current models to respond into financing that gap that has been established. So when it comes to differentiated specific model to address this requirement, then the local banks, I know, have what it takes for them to meet this specific space. Another thing is that if you look at the solutions in terms of technology, I'll give you an example. The M-Pesa payment that has gone global, the digitization of these banks, of the African banks in terms of payment, when they now consolidate and come through and play the active role in trade solutions, which we've not seen an aggression in solutioning digitally the trade solution. We believe that it's the right opportunity for the African banks to come in and play in that space. But at the initial stages, the liquidity will be impacted, and there will be less liquidity because of that sudden reduction. But going forward, it does offer a very good opportunity for the local banks to come in, and with the partnership that we have, be it with IFC, be it with Propaco, so that we can be able to strengthen these banks and play their rightful place, then we will not have a gap. But if that doesn't happen, then we will see some strain. Having said that, again, if you look at the local banks, the African banks, and the correspondent relationship that they have globally, they come in strongly to meet that expectation. And that's why we are saying, as an African continent, there is a lot of partnership that we need to bring in place so that we can increase and play strong in that space that is going to be created. And finally, when we talk about governance, then we need to ask ourselves, as the financial industry, as the African banks, how solid are our governance in our own Africa perception and global perception, so that we can be able to trade internationally. And when you look at that, there is some area that we need to increase our governance, and especially in such a way that the global partners have sight for that, so that they can believe that these African banks do not introduce or give heightened risk in terms of banking or partnering with them. That's how I'll put that to you, Rama.
Thank you. Thank you very much. Rita, there's a question here for you from Fuad Nicola. He's asking, he's saying rather the only example he can think of a Middle Eastern bank investing in Africa is QNB. I believe that's the Qatari National Bank, investing in EKO for around 22%. Do you believe that this partnership model is effective and positive when it comes to African trade and financing?
It's not a question of yes or no, but I think it depends of the partnership. I think that which is clear today is there is huge interest or appetite of Middle East player to Africa, and when we say Africa, there is a part of North Africa where Middle East already present, and with the Middle East player financial institution, I think that try to finance, to try to be present in trade finance. They guarantee, they invest, and I think that they are even created a kind of funds and so on. In Africa, East Africa, I think that we see in Ethiopia, in Kenya, in countries where there is a real let's say resource, oil and gas, gold, and other agricultural resources. I think that we see a big interest and the appetite from Middle East player to present themselves as alternative today, or as intermediate, let's say, to access to international market. And I think this is the position that that Middle East play, in addition to this interest to positionate themselves as a player for oil and gas facilities, financing, for industry transformation, for trade finance, but with a certain level of guarantees and product. And I think that just quick response is that clearly there is appetite. We are looking for a concretization, a clear, let's say, opportunities and clear implementation of Middle East group in Africa. But I think it can take time because I'm not sure that Middle East players are understanding well the specificities of African countries. So we know that EcoBank, the QNB, which was present in EcoBank in their capital for more than a lot of years there, but there is no presence of QNB as actor in Africa, but we see only EcoBank. But there is a lot of room of development of EcoBank through QNB, for example, or three other Emirates or KSA player today. So I think that this trend we are seeing when we look at the trade finance, the history of trade finance. Middle East was, I think, that 3%, less than 3%, 10 years ago with trade finance with Africa. Today are 7%. So there is investment in ports, there is investment in infrastructure, there is a partnership to facilitating the trade, there is some guarantees accredited by Mashraq or by other international Middle East player. So I think that, yeah, Middle East can be, as I said, a region that can boost and can be an interesting partner for Africa. But also, I think that for me, we have to look and to have an interesting negotiation for that by African player. But I would like to come back to the discussion, which is very interesting. And for me, I think that there is 3 pain points for financial institutions and for African countries. The first one is infrastructure. And there is a huge gap of infrastructure in Africa. And what we are saying today is that our financial institutions have to grow more to be able to finance a huge infrastructure project. And I think for that, we need interested partnership with international donor or international player. And I think that the point that can facilitate today this partnership is a green bonds, is the emission of green bonds, of the emission of sustainable bonds, focus on infrastructure, on green energy, on a sustainable agriculture. I think that this is a way that we can attract foreign currencies from international players to make a huge infrastructure project happen And I think this is a focus, it can be the first focus that we can have in looking for how we can maintain international investor appetite, or how can attract foreign exchange in Africa. So green bonds it's important. The second pain point is that trade. We already, I think, that discussed about trade finance, because to move from 15% of intra-African trade to 30%, for example, or 40%, like African Union said in 2050 or 2030. This means that we will see about 7% growth of GDP in Africa yearly, annual GDP growth. And this takes time, because we have to invest in regional supply chain, in agriculture, in agri-food, in education, and so on and so on. So for that, I think that we need a question of hub or regional correspondent hub to help us to maintain this relation between Africa and international player. Let's say kind of transition until we have a big financial actor, financial institution actor that can acting as a local correspondent bank for small or regional banks within Africa. And I think this is the ambition we need. It means that tomorrow we need EcoBank as correspondent fund banking for Coris, or Standard Bank is a correspondent banking of other local banks. This is interesting to see that, based on the size, based on the rating of this Pan-African group. So I think this is the second point. The third pain point is that SME lending. I think that already said by in the discussion. I think this is the point. Yeah, sorry, where we need only local currencies. Yeah, Rama.
Yeah. That was Anastasia. Was talking about SME lending. My bad.
Anesthesia, sorry. Yeah, anesthesia, sorry. So this is a good point, because for that, I think that, okay, we're looking for foreign currency for infrastructure. We are looking for corresponding and foreign currency for trade and international player. But I think that for SME lending, I think we have to put local currency on that. And I think that already Mohammed said, saving, pension fund, liquidity pool, diaspora pool. I think that's something that we have to rise internally. And I think there is a liquidity in the market, and up to us, up to financial institutions to rise financial, let's say, local market to finance SME lending, our SME lending. And it's been complicated to rise international loans or international credit from outside in foreign currency to give money to local currency, only SME lending outside trade. So I think this is the picture that can help us to propose a pragmatic solution for the continent.
Gonzaga, I want to come to you on the question around FX risk, because, from Popaco's perspective, you're mobilizing capital either in euros or US dollars, and you're deploying it into markets that are operating in, CFA franc, the Kenyan shilling, the Tanzanian shilling, and so on and so forth. And some of those currencies have taken a bit of a beating over the last, say, 5 years or so. Kenya had its own period where initially the dollar liquidity was a bit of a problem. The market wasn't working as it should. Currency adjusted. Now that's working well. Tanzania is probably in a comparable situation at the moment. Have we managed to crack how to manage FX, the FX risk of lending into markets here in Africa, or are there still more solutions that we need to deploy into the market? Sort of the things like, say, for example, TCX is doing.
Yes, thank you. Perhaps just on a last point on what Rita was saying on SME lending, just to mention that indeed SME lending requires local currency, and this the banks have, and it requires the willingness to take SME risk. And this is something on which we also help our partner banks by providing portfolio guarantees to banks that finance SMEs and want to share part of the risks of those portfolios. And so it's also let's say, a market failure that we're trying to address in that way, and to help the banks that are willing to go into that market by taking part of the risk with them. But going to your question on forex, I mean, it's to answer simply, no, we haven't cracked that nut. The forex risk is a main component of the risks that the banks bear in African markets. People such as us who provide essentially foreign currency are not doing anything significant to reduce that. What we do is provide resources that these banks use to fund their hard currency activities, and this is something we look at in a lot of detail when we work with our partner banks, is how they manage the risk, the foreign currency risk on their balance sheet, and making sure that the resources we provide meet the needs that they have, and that we're not providing resources that are in the wrong currency to finance what they want to finance. But as you said, there are instruments which in certain instances are extremely useful. TCX is one of them, and it's an instrument that we see as being extremely useful to provide local currencies to players who have no need whatsoever for hard currency. We often use this type of instrument, which has proved extremely effective in the years it's been active, and is an important part of our offer on the continent. Absolutely.
Anastasia, I want to come to you, the question here around tech, because I know you've spoken about how if local banks really want to be competitive, especially in the retail and the SME market, we have got to deploy as much tech as we can get on, as much tech as we can get our hands on, to essentially be able to meet our clients' needs as in the most granular way possible. And there's a question here from Wassel Briana, who's saying that, look, the real challenge here is essentially banking the unbanked. And what he's asking is, can tech help banks be less averse to the 77% who are unbanked or underbanked in the continent? And I'm going to put a little spin on that, because I think right now in pretty much most markets, South Africa, Kenya, Nigeria, huge parts of West Africa, there's a huge digital paper trail, right, of all of our transactions that we make on mobile money or transfers to and from the bank. And from the tech perspective, one would say, banks have a ton of information on what SMEs and individuals are doing, but are we making enough use of all this data that we're sitting on?
Thank you. And you are spot on. For us to be able to bank the unbanked, the only cost-effective way to do this is through digitization. Otherwise, the margins will be so narrow that if we are careful, it will erode the shareholder value. Having said that, look at what PAPS is doing. That's an excellent innovation. In terms of technology, what's really going to enable us bank the unbanked and the mass market and to consolidate these savings into liquidity is through technology. The second thing is that we have a lot of information as a financial institution. However, in what form? That's the biggest question. And that's why there is every business case for us to accelerate our technological uptake and partnership with fintech and address our traditional infrastructure. Why is this very important? For you to be agile in technology, then this information, the static information, must be used and consumed at the right time, real life situation that brings meaning to the customers. So for Africa, technology is key, and knowing the financial needs of the customers require that data to be meaningful so that we can meet those needs. And then finally, tech is also going to assist us to document and have an elaborate process to address some of the perceived risk management, risk challenges of the Africa continent, because you'll be able to track the transaction from end to end. And allow me say this, Rama, we've made baby steps. We've made progress as African banks. However, we need now to accelerate so that we can maximize on the existing opportunities, and especially through MSMEs and SMEs so that we can scale them up. And finally, we need to be in the table. To be in the table, to be able to make the right decision and policies which are unique to the requirement of African customers, SME, and come up with models that speak to their financial requirements. Thank you.
I'm going to fire off a last round of questions here because we're getting close to our termination time. But I want to start with you, Akintowan. With respect to something you mentioned a little earlier, and it sort of speaks to the point that Anastasia's just made. Yes, we want to grow across the continent, but when the rules of play are different, the instant you cross over from Southern Africa into Eastern Africa to Central Africa, and so on and so forth, I mean, at some point, there's got to be a sense of commonality, right, across all of these markets. These regulators need to be talking to each other. If you were sitting down with a college of central bankers, what would be on your list and say, look, guys, if you want us to expand, these are the top 3 things that we need to see?
I think from a central bank perspective, I think regulations, exchange controls will be a critical point in that engagement. I think if you go across Africa in general, the FX regimes are very different. So in East Africa, for instance, you hardly have any exchange controls at all. But in large parts of West Central Africa, you have very extensive exchange controls. If Africa is going to trade with itself, I think we're going to have to harmonize that. We're going to have to simplify that for intra-African trade to help facilitate it. So I think some kind of exchange control convergence might be a good idea as a good place to start in terms of facilitating intra-African trade, maybe only for intra-African trade. I think some kind of liquidity provision platform for the currencies themselves, where it's relatively easy to switch out of one currency into another. That's why the involvement of the central banks in things like the PAPs is very critical. And I don't know the extent to which they've been involved. I don't think they have to a great extent, but I think it's critical because it can't work without their involvement. They have to be part of it. They have to drive it because it has to be easy to access liquidity in the different currencies if we're going to grow this intra-regional trade in the manner in which we want. And if we're going to de-dollarize, quote unquote, you have to have alternatives readily available, and it has to be easy for people to find that liquidity to deal with. So the central banks have to be active in that regard. I think also orthodox monetary policy is important across the board. I think there's too much unorthodoxy in monetary policy in Africa in general. Things that tried and tested and failed still get revived and tried again. And the outcomes are never different, generally speaking. They continue to fail. We focus too much, I think, on the level of the currencies rather than on the fundamentals of what will allow us to stabilize those currencies. You can manage a currency and allow a gap to the parallel market and think that works, but it doesn't. In the end, it catches up to you. We have to focus more on the fundamentals on the monetary policy side and on the fiscal macro side of what determines the value of the currency itself and try and get that right. And that's how you get sustainably stable currencies. And I think across Africa, you need that commitment to orthodoxy, to evidence-based policy making, as opposed to interventionist, extraordinary type of measures that sound good and sound like they might work, but almost always fail and make things worse. So I think for the central banks working together, just offhand, I would say those are some of the things to look at with a view to enabling intra-African trade and facilitating its ease.
Indeed. And we're really approaching the essentially our sort of time limit to getting to the red zone now. But I'd like to fire off one last question to all of the panelists. This coming in from our audience here. Do we need to adapt Basel requirements in order to meet our local context? Because on one hand, yes, we need, we've spoken about how there's an enormous need for capital to be deployed in trade finance, in financing infrastructure across regions, more often than not. But can we still do that while remaining faithful to Basel III requirements, for example? Anastasia, I'll start with you very, very quickly, then Rida, then Gonzag.
We need to adapt the best standards globally, because remember that when we are facilitating trade, we are facilitating through partnership with the global actors. So specific. Having said that, we also need to domesticate some of the requirements which are unique to us and make sure that we have strengthened our African banks so that they can be able to grow globally. So there is a need for us to look at, so what are some of these unique risks which are specific to our continent, and how do we mitigate them so that we are here for the long run, and so that we've strengthened the financial institutions so as not to introduce perceived or real risks. So there's every reason to adapt standard, but also build in some of the risks that are unique to our geographical environment and mitigate those risks so that we can be competitive for the long term. Thank you.
Thanks. Rida, do you want to weigh in on Basel requirements? Do we need to adjust them for local?
To our long term. Thank you.
Yeah. I think that, which is important, I think that for me, is that we need to comply with international standards, because we are working with international player, we are working with international donor, and I think this is important to have, let's say, a common standard, a common language, to be able to work together and to be able to communicate together and to trust together. In terms of international accounting, IFRS, or international standard of solvency like Basel or Solvency II in insurance. And I think that also it gives us, or push us as financial institution to have more efficiency, more transparency, and more compliance, which is important in the maturity, or to mature our financial institution. And I think that we need this kind of regulation. But I agree with Anastasia on the point that we have specific risks that are not perhaps mitigated through the Basel III guidelines. So I think that, we need to adapt, to customize based on this specific risk that perhaps require more risk mitigation solution, or more capital requirement, rather than capital required for other risks, standard risk identified by Basel that require some ponderation of capital and so on. So I think that is question of what kind of variable we need and which ponderation we give to this risk. And I think that some risk need to be in the table and discussed in the table. That's why I think that the next question is to say, what is financial institution in the global standardization, or the global standard Basel II? What is the voice of African player in this standardization? And I think this is the good question. And the question also gives us is the size, the critical size, and how we can give this, let's say, financial institution the ability to change or to adapt this regulation to African player.
Yeah, it's certainly a question.
Yeah, go.
The next meeting at BIS. Gonzag, you get the last word on this with respect to Basel requirements.
Thank you. So I'll try to be short and not repeat what's already been said, which is quite true, that the specific risks of the African banking sector need to be built into this regulation. I would just say that it's important that this regulation is as similar from one country to another as possible, to make it more easily readable by foreign players, and that it needs to be close enough to the Basel requirements to create trust and confidence in the banking sector, which is key to attracting capital in the future.
Indeed. And we are essentially now getting into the closing stages of the conversation. So I'd like to extend a massive, massive thank you to all of my panelists, Gonzague Montreal, Rita Mefta, Anastasia Kimtai, and Akinsuwan Dawudu, for their time and their insights in this conversation. And of course, I can see there's still a few questions that are coming up on the chat conversation, including one where Jack Herman Toko is essentially trying to see how he can reach out to KCB Bank or even Citi in order to support your initiatives on trade finance, supply chain financing, invoice financing, and so on and so forth with the tech team that he's working with. Now, just before we close, a couple of housekeeping rules. We, of course, do these webinars in advance of the big event, usually at the end of the year, November or December. So this year, we're going to be in Casablanca. That's right. We're going to be the shores of the Atlantic in that lovely, lovely country on the 9th and the 10th of December in partnership with IFC and the Kingdom of Morocco. Massive range of conversations that we'll be having over there, covering everything from trade finance, insurance, the risk perception conversations you've just seen us having now. We'll be talking to central bankers over there. Last year, we had fantastic conversations around where they see the role of tech and crypto. Heated debate on that particular one. If you want to see the replay of that conversation, it should be available online on YouTube. It's a fantastic thing. And please do register. We'd love to see you there in person. Also, before you get to Casablanca, we'd like your input on this, the African Financial Industry Barometer. It's something that we always do in advance of AFIS, and then we present the outcomes of this survey at the start of that very summit. It usually makes for very, very interesting reading. We tend to do it with the team over at Deloitte. So please do provide your input, your thoughts, your views into this specific study. You can find a link for that in the webinar chat at the moment. And of course, you can register for the African Financial Industry Annual Summit in Casablanca on the 9th and the 10th of December. The link to do that as well is also in the chat at the bottom. Ladies and gentlemen, that has been our webinar at the very start of Q4 2024, the 1st of October. I can't say a massive thank you. I can't thank my panelists enough for their time and their input and their expertise. And of course, to you, our audience as well. You've been fantastic with all the questions and the opportunities and the debates that we're seeing playing out in the chat as well. Hopefully, we'll get to see you doing this exact same thing in person in Casablanca in December. From me, Ramanyang, in the Kenyan capital, Nairobi, thank you very much for your time. Bye-bye.